last probably 10 years, I have been focused mainly on institutions that are in crisis situations. And I've been busy the last year with COVID, as you can expect. So I'm going to share a couple tools with you and give you some examples of some information. So what we're really going to focus on, two tools today. One is the risk appetite that an institution should have, a statement. And the other one is a management level risk committee, okay? It's not a risk committee up at the board level. This is more at management level. So the sessions today really is for risk departments. I see there's a lot of people here. We have like 80 people here attending, but my focus is really going to be for risk and managers. But I think, sorry.
Okay.
No, but this will also be information. I'll have lots of good information for others also. So I will continue. So what is risk management for an institution? I wanted to start with this statement and kind of talk about that. Let's be honest. Financial institutions are in the risk business. We make loans. We take our money and we give that out. Once it leaves our doors, it's risky, right? That we have to pay it back. So, but as a risk department and as an institution, we need to understand the risk. We need to measure the risk, and we need to communicate the level of risk. And who we are communicating it to is the senior managers and the board of directors, because they will decide the appetite, the risk appetite of the institution. They will understand if the risk needs to be lessened, if it needs to be controlled, deleted, or in some cases, they will accept the risk. It's risky. They're going to accept the risk to make a loan, but they're going to set policies and procedures to make sure we get the money back. So, hold on one second. But what we don't want for a financial institution is surprises, okay? COVID was a surprise. Let's be honest. Did we think we would have a pandemic? I didn't. I never expected it. But the institutions I've worked with in the last year, they did not expect a pandemic. However, they were ready when many institutions people could not work at the office. Many countries had said people have to work from home. And there was many institutions I saw that had plans to allow their staff to work from home. They knew there could be an incident that they couldn't work in the office. So they made some type of plan to work from home. So yes, the pandemic was a surprise, but they were also putting policies, procedures in place. So the certain specific surprise they were ready for. So let's talk about a financial institution's risk appetite. What is a risk appetite? Okay, let's talk about this. A financial institution always has to set some specific measurable goals and benchmarks for all risk. We don't want to just throw money out the door, right? That's not what our institution is. I used to know a bank president I used to work for who said to me, no money, no mission. We want to give money loans out to our businesses, to our clients, but we want the money to come back, because if they don't give it back to us, we can't give it again. So that's the important thing here, is understanding we have to set some limits. So these goals and benchmarks are based on a credit culture and a risk profile. Credit culture is our credit values, beliefs, our behaviors. And the risk profile is the levels and type of risk that the financial institution has in their balance sheet. So let me give you some examples of two different appetites, okay? There was one financial institution, a non-bank, that gave out microfinance loans to small micro businesses in Bosnia-Herzegovina. And their risk appetite was they wanted less than 1% portfolio at risk over 30 days and no charge-offs. What that means is they wanted, out of the entire portfolio, only 1% of the portfolio could be late over 30 days. and they wanted no charge-offs during the year. They wanted 3% loan portfolio growth annually, and they wanted an acceptable level of profit. So they wanted a little bit more than break even. Okay, so that's one institution. The second one I saw was in the Republic of Moldova in Eastern Europe. This gave more smaller loans to very small businesses, and also they gave consumer lending. But again, smaller loans. They wanted a 90% recovery rate. So they didn't care how much the loans were late. They just wanted to make sure 90% came in the door. Okay, so it might be late, but they would charge a very, very high penalty rate to make the people pay that. They had a very good collections department. They also had, they wanted 15% loan portfolio growth annually, a very high portfolio growth, and they wanted very high profit level. Okay. So what we could say is the institution in Bosnia probably wanted low risk, right? A low risk appetite. And the Republic of Moldova, they had a high risk appetite. Let me tell you the differences of these institutions. The one in Bosnia, I was called to go in for a year in 2010. They were failing, and the investors were very nervous. They thought this institution was not going to survive, and it barely survived. I'll always remember 1 week they couldn't pay salaries. They didn't have enough money. So they cleaned up. The investors had asked for all the money back, and they made significant changes, and the portfolio went from 50 million to 25 million, half in 3 years, because they had to collect the loans and then they had to pay back the investors. After that happened, management was so, let's say, conservative, right? That they really wanted a low risk appetite. The Republic of Moldova, that institution, that financial institution only was born in 2015. It had never been through a crisis, and it didn't have the memory, and it had investors that wanted a high dividend. They wanted to take the money out of the institution. So that's why they had a high risk appetite. I'm not saying one is better or worse, but I'm just saying this is how the board, these are the parameters the board set to set the appetite of the institution. So let's just quickly go through this chart that kind of tells you how it's set up. So the board is looking at how much capital, how much equity does an institution have to absorb the risk? And then they're saying, what is our risk appetite? How much are we willing to risk? The board decides that, and then based on that, they hand that down to management, who sets the target risk profiles and the actual risk profiles for the individual risk, credit, interest rate risk, even operations risk. So the statement of appetite will be a board level activity. It will quantify and qualify the desired level of risk that an institution wants to take. It's expressed in limits. It's refreshed annually or reviewed annually. And it should not be a statement of what the financial institutions aspire to. It should not say the company wants to be the largest financial institution in Ghana. No, that is not what a risk appetite is. What a risk appetite would say is the company does not accept risks that could result in a significant loss of its revenue base. So it's saying it doesn't want to take any risk on maybe new risky products, or maybe go to a new geographical area that could result in a significant loss. Let me be honest with you. 20 years ago, when I was working in a financial institution in the US, we did not have a risk appetite. We had the risk benchmarks that were established, but the risk appetite really developed the reason for a risk appetite, and why regulators now around the world want risk appetites is because of the financial crisis in 2009, 10. Many financial institutions did not make it. And they found that many institutions, the board did not understand what the risk was, right? So having a risk appetite is forcing the board and senior management to be in an agreement on the amount of risk that's accepted. So this is something a bit new that's come out probably in the last 5 to 10 years. And still many institutions don't have it or kind of are developed in the different stages of development, which is understandable. So let me give you some examples of what statements would be in a risk appetite. Quantitative earnings do not deliver compared to companies' peers. So what that is saying is annual earnings have to be on the same level of what the peers in your market is, what maybe the financial comparable peers in Ghana. That could be like a return on assets or return on equity, just looking at a percentage, maybe not a specific amount, but just a percentage. They're just saying we want to be at least what the average is in the market. The other one could be the capital ratio, that you want to say capital to total assets would not fall below 6%. Qualitative ones that are a bit more hard and difficult to manage in someone is I've seen it, they say that the board will say, we want to manage growth effectively. We want this, what they literally are saying to the management is we want you to monitor some early warning indicators of non-sustainability, which would be, of course, probably looking at income and losses closely on a monthly basis to see if there's any trends that would mean that the institution would fail. It would not sustain. Here's another one I saw that financial institution. The board said, we're going to limit our business activities to retail and commercial lending. It was telling management, you're not going to do corporate lending. You're not going to do anything but retail and commercial lending, which is fine. The board has all the right to dictate this. The other is what I see in majority of risk or financial institutions is they want zero tolerance risk. And this means they want no flagrant breaches, fines, or headlines, no breach of delegated authority. Okay, so the key one here is fines. They don't want any regulator coming in and fining, penalties to the institution because they did not adhere to something that the Bank of Ghana, the National Bank of Ghana had dictated. They're saying you have to uphold to all our regulations. This interesting one is headlines. It's reputation risk. A financial institution does not want to be in the headlines for something negative because that could be detrimental. There was a financial institution, I remember, that took deposits in UK, and there was a big headline because people complained that there was about $100 missing in many people's accounts. One morning, somebody hacked the system and took a tiny bit of money from everybody's account. But believe me, that headline was detrimental to the institution, who then lost a lot of customers who took all their money out because they didn't want to risk what was happening. On top of it, the next day headline complained that this financial institution, that nobody could contact their customer service, that their phone lines were busy, to ask why is there £100 missing from my account. So 2 days in a row they had headlines. So that is a very common one I see with financial institutions, that boards are going to say, we don't want to have any fines, any headlines, and you're not going to breach the authority, the delegated authority that we give you. So now I want to talk about the Management Risk Committee. Okay, so per your Bank Ghana Corporate Governance Directive 2018, it says that the board is required to ensure a risk management function. It can be a chief risk officer or something equivalent, with sufficient authority, stature, independence, resources, and accountability to the board. It also says that senior management is responsible for the oversight of the day-to-day management of risk. So the financial institution I worked with originally on risk had a management risk committee. This is not at the board level. This is at the management level. And I saw how effectively it managed risk. And I also am going to share a tool with you that they used, risk matrix, that was very useful. But I wanted to talk to you about a management risk committee and how it works and the good things I see about it, also maybe the cons of it, the negative things, and how it can be run and used effectively. So you have the board of directors that will delegate your authority to the management risk committee. And I'll tell you, we'll talk about who's a member of this committee. Then, which is chaired by normally a chief risk officer or a risk manager who answers to the board of directors or the CEO. Normally it should answer, I prefer the board of directors, but the chief risk officer could also answer to the CEO. Okay, so the board of directors is actually giving the authority to manage risk to oversee risk to the management risk committee. So the management risk committee will meet monthly at a minimum. I've seen during crisis situations, it could meet actually 2 times a week because they're watching what's happening. During the pandemic, many institutions I saw were meeting weekly. And the possible participants are the CEO, CFO, risk officer, maybe the manager of lending, of operations. The internal auditor can sit in the meeting, but is not allowed to vote because the internal auditor normally answers to the audit committee of the board. The internal auditor is the eyes and ears of the board. So they are not part of management. So they shouldn't be voting on any specific issue in this committee, but they are more than welcome because of transparency to sit in and listen, because it's good to have an internal auditor knowing where the risks are in the institution, because then they can actually target their audits to that specific risk area and help management understand what's happening. So this risk committee, and I'm going to talk to you about the agenda in a minute, does the process of determining if the risks in the financial institution that are accepted are appropriate to the rewards it wants, right? So risk versus reward, and it's a free flow of ideas, this type of meeting. Okay, so one problem I see with institutions with a management risk committee is that many financial institutions or management committee members, I can say, feel that a committee is not that important if there's a risk officer. So maybe they'll even have a committee, but the risk officer will present the information and nobody votes, nobody talks about it. It's just kind of a rubber stamp, as we say. So it's really important that even if there's a risk officer, that the committee has fruitful discussions. Here's the agenda. You're going to talk about the current economic conditions. Why? Because this is going to affect your institution, right? If there's currency deflation, if there's interest rates that are increasing, this will affect your institution because it's going to affect your assets and your liabilities. And that's your other discussion. You're going to look at your asset mix, your funding mix. You're going to then have specific risk discussions on certain risks. You're going to talk about internal controls. And that's when the risk matrix comes into play, which we're going to discuss next. You're also going to talk pricing, interest rate margins. Why would we talk about that? Because sustainability risk. We want to make money on our loans. I'm not saying you have to make a lot of money, but you want to make an acceptable amount that you can pay for operations, right? We don't want to show losses during the year. We want to be, the institutions want to be self-sustainable. So it's an important discussion during this committee to discuss the interest rate margins. And then you can talk about new proposed products and services and the risks that are associated with that. So what are the pros and cons of this committee? The pros is that there's more eyes and ears discussing. One of the biggest pros for me is that the risk is contemplated by the entire management and agreed upon, or if I should not say agreed upon, at least understood by. One of the biggest problems I have when I go into an institution to work on risk management, right? To understand what's happening, maybe develop a risk officer or a risk department or even risk committee, is that I see that each manager of a financial institution is in their office by themselves, and none of them are discussing risk together, right? Because the way a chief financial officer looks at risk compared to the head of lending or the COO, the operations officer, it's all going to be different. They each have a special skill set and a special understanding, but it should be shared and everybody should be agree on, or at least understand what the acceptable level of the risk in the institution is. The other thing this risk committee is very good for, it's forward looking. Remember, we want no surprises. So this also can contemplate if there's any new risks coming in the future, like increase in interest rates, or if there seems like something might happen with the loan portfolio in a certain industry that is served by your financial institutions. For example, I worked in Kenya with a microfinance institution, and they did a lot of funding of people that sold used clothing. Well, what happened was we had a good portion. We had a lot of loans to these type of clients, and then all of a sudden the government decided to outlaw it. And then we had a lot of problems. People had to have a formal license to be able to sell this, and people didn't have formal license and they couldn't afford the formal license. So we had an entire portfolio started to have problems in non-payment. So this was also forward looking. When we knew this law was coming into place, we started talking about how are we going to handle our clients. We got to go talk to these specific borrowers and find out how are they going to handle this and how are we going to get repaid. We didn't want to pressure them to pay us. We wanted to just understand the situation, understand what was going to happen the next month or two when the regulation was going to go in force. The cons is, yes, it's another meeting. It takes time, and I know you have a lot of meetings. It also is, if no person is developing the reports, it can be inefficient and ineffective. You need, hopefully, a risk manager or a risk officer that's developing the reports to present to the committee. The last one, it can allow for group thinking. So people get together, but they don't want to contradict or to challenge each other. Maybe they're friends, or maybe they don't want to have the time. Maybe they didn't look at the report, but the committee needs to be able to challenge each other. Because if you're all group thinking and don't want to question each other, then it's not an effective management risk committee. One of the handouts we're going to give you is a management risk committee charter. So this charter will outline who's the members of the committee and their responsibilities. And I think it even includes like a agenda in it. So if you have a management risk committee now, you can compare and see if there's a charter. If they don't have a charter, I would recommend using this charter. And if you ever want to start a management risk committee, you can look at this charter to help you dictate this. One question I always get is, well, okay, what's the difference between an asset liability committee, a management risk committee, and internal audit? Okay, so here, let me explain this briefly. So asset liability can be a subset of the management risk committee. It's more focused, I think, on the balance sheet risk, on the asset liability mix, if we remember from the agenda that I just showed you. So for example, when I worked at my financial institution in the US, there was a management risk committee that would talk about, well, let me explain to you. This is about overall risk. It includes all the senior management members usually, and can provide recommendations, even setting an audit. So let me explain how it worked in one institution I worked in. So they had an asset liability committee meeting, and they usually included the controller and I think a treasury officer to come in to sit in those committees. And then when they were done talking about the asset liability mix, those people left, and then it was just the senior managers that would have the rest of the risk committee that was looking at non-financial risks. They were looking at the operational risk, reputation risk. They're also kind of looking at the overall enterprise risk. When I say that it can provide recommendations in setting the audit schedule, management can't set the audit schedule, right? That is supposed to come from the board. However, hopefully, if your internal auditor is sitting in the management risk committee, they will see where the risk areas are, and you can understand where the internal audit may need to focus on, or even ask them to focus on it. They don't have to do it, right? The internal auditor is not answering to the CEO. The internal auditor is answering to the board. But if management and the internal auditor work together, they can help each other to understand where the risks are in the institution. So as I said, the internal auditor mainly is the eyes and ears of the board. And some of the information the internal auditor gives will feed into the management risk committee. So the internal audit reports that the internal auditor will be doing would be given to the risk committee to read. After the board has read them, of course, because the board has the first view of all the internal audit reports. So I mentioned in the meeting that there is a risk matrix. You will get a copy of this risk matrix. This is probably one of the tools I've introduced, I don't know, probably to 30, 40 institutions around the world to manage risk, okay? So what this is, it is Hi, if you could be put on mute, people can be on mute, it would be helpful. Thank you. So this tool is usually reviewed by the risk committee on a quarterly basis, or even monthly. And it's completed by compiling information such as liquidity reports and credit inspections, internal audits. And it summarizes the risk priorities and directs attention to the high risk areas. Normally it is managed by the risk officer, the risk manager, but it also is important that all heads of departments are looking at this. I will be honest, to develop this risk matrix takes time. I went into an institution, I think in Papua New Guinea, and it was 2 weeks of meetings with senior managers and department heads to come up with a 3-4 page matrix. Once the matrix is developed, it's not as difficult, but it does need to be reviewed more often because risks change, right? Nothing is static, nothing stays the same, right? You have a pandemic. Okay, that was a black swan. That was a huge incident. But even little things change in an institution. That's why there has to be a minimum of a quarterly review. So this is how we're looking at the risk profile. And again, you're going to get an example of one that as a handout, but this, I just want to give you a little bit of an overview of what this looks like. So we look at the quantity of risk and the quality of risk management. To be quite honest, the quantity of risk is how much financial impact will this have on the institution, okay? And the quality of risk management is the oversight and the policies, procedures to kind of control that risk. Now, let me give you an example. I went into a financial institution and they had a number of branches and they had a petty cash box. And this was, you know, a little bit of money for staff to use to get reimbursed. Maybe they had to take, use taxis to go visit a client. It is a small amount of money. They didn't have the controls in place in the branches. So the quality of risk management, they weren't writing down who was taking the money. It was weak. Okay. but the quantity of risk was low because it was a tiny bit of money. And so overall, if you look at the quality of risk, weak, but the quantity of risk was low, it was a moderate risk. It wasn't a high risk, even though there was weak controls. Now, let's say you had lending and the let's say loan policy, right? The quantity of risk could be high. If you don't have a loan policy, how do people know who to lend to, what to lend to, how to lend, how much to lend to? And so if, let's say you had a policy and it wasn't updated in years, and believe me, I've seen it. I went into an institution recently, 3 years it had not been, and they are totally doing different lending. It was not updated. So actually the quality of risk was high and the quantity of risk was quality of risk management was weak, because they should have been looking at their policies annually and updating annually, especially because within 2 years, 3 years, they changed the type of products they were doing. So it's actually high risk because they don't have any policies and procedures for that type of lending they're doing now. So let me give you some examples. This is actually, I cut it and paste this from a matrix. So this is a financial institution that had business lending. It also had consumer lending, and they broke out their activities. And you will see there'll be lending, but there'll also be some areas, activities, operations, also accounting. You'll see how the matrix is set up, but I'm going to focus on the lending right now. So there's a business lending unit, and their credit underwriting had an aggregate risk of high. And why? If we look at the comments, they had an entirely new loan team. The entire team had left, and even the manager. And they started doing more complex deals, and they had high goals. So the aggregate risk was high because the risk management, these people, were they trained? Did they understand what type of lending? And we felt the risk was increasing. Now, who would have decided this? Risk department would have decided this and talked about this at the management risk committee and said, this is why we see it's a high risk. And this is why we see it's increasing. Until we feel comfortable, the lending team is trained, then this is why. So the next one was loan administration. And if we look at loan monitoring, the aggregate risk was moderate. There were good policies and procedures in place. And the quantity of risk also, since it was acceptable risk management practices, it was a moderate risk, but the risk was increasing. And why was it increasing? Because there was new loan monitoring procedures in place that we did not, as I'm going to say, I'm acting like the risk unit, the risk management unit. We didn't feel, and management were worried that they weren't doing it or understanding these new monitoring procedures. And it was a new, we call hot button area for the focus of regulators. We knew the regulators because we had known that they were going to come in and examine our loan monitoring procedures, because they were focused on to see if we were following up with clients in a timely manner. And they had penalized and fined other financial institutions in our market because they said they did not have clear monitoring procedures and the staff were not following the procedures correctly. So we knew that this was an increasing risk direction because we were very worried about the regulators coming in. So that's an example of that. Risk matrix, some problems and issues. It's not reviewed enough. As I mentioned, risk is not static. It doesn't stay in one place. It's always changing all the time. So you have to be reviewing it. It's not presented clearly and not supported by information and data. So if you say the quantity of risk, the quality of risk management is good, then we should be able to back up why we think the quality of risk management is good. No actions develop from the findings. This is the most frustrating thing for me, is that we develop a risk matrix with an institution, and we say the risk is high, or we say the risk is increasing, and they don't say any action, and they don't give anybody responsibility to make sure we lessen the risk or that we understand the risk better. Like, this is not supposed to be, okay, we've done the risk matrix, we walk out the door. No, it is supposed to be, we have to make action plan from this. The other issue is the responses are not honest. Nobody wants to admit increased risk in their department. You know, who wants to admit that? We're all, you know, my department's perfect. And then the other thing is it's not tailored for the specific institution. I'm going to give you this risk matrix. You are more than welcome to use it, but tailor it for your institution and take the time with senior management to go through it step by step and make sure that it's for your institution and not for another institution. That's the only thing I ask for this. And as I said, you're going to get a copy of a completed risk matrix for that I did and that I worked with an institution. It's very detailed. You don't have to have it as extensive as the one that you see, but some sort of matrix will help you think about the overall risk, especially operational risk of your institution. So I think that's it. I think we're going to, if you have any questions, put them in the chat box. And I think now we are going to have someone talk about what's next. Yao? I'll start, and if Yao will come in, maybe he's on mute. The handout, the tools in this presentation are going to be sent to you in 24 hours. The project. You
can continue.
Oh, God. I should continue. Okay.
You can continue. Yes.
Okay.
I will come in. Yes.
Okay.
Thank you.
And they're going to be looking at risk management in multiple areas over the next year. And they're going to be doing a feedback form for this. And please be honest what you think of this presentation and other areas of help that you would want, or other area of assistance or other webinars you want. There are a few webinars coming up. It's a very exciting one on December 1st, developing a digital strategy that I wish I could attend. And then in January, you're going to have 2 investment readiness. You're going to have an introduction to investment readiness. This is for financial institutions that haven't sought large institutions before. So this is going to help you think about that strategy. And then the next one is going to be advanced investment readiness. This is by financial institutions. This is for financial institutions who have a large investor, but are looking for more. Why just have one? Get some more investors. Does Yao, you want to say anything? Or Alex?
No, you can continue.
Okay. So I was going to ask now, I can't tell from the chat box, are there any questions at this point?
No, there are no questions in there.
Okay. Then
I can see a hand up, but I'll ask him, Augustine, type in the question in the chat box so that I'll pick it from there, please. Augustine, type in the question in the chat box and I'll get back to you, please.
Alex.
Sir.
I think if Donna still have some few minutes, then you can allow them to ask the questions instead of typing it and taking some time off.
That's okay. Yeah, they can ask it too. That's a good idea, Yao.
Yeah.
Okay, that's fine. So if you have any questions, you can let us know, raise your hand, go to the reactions column, then give us a hand up. They will ask you to come in with your questions, please. Thank you.
So one question, oh, okay, we can take the question. Augustine.
Augustine.
Yeah, hello.
Hi.
I want to know what are the components of, how should a risk framework look like? Or what are the components of a risk management framework?
Okay, very good question. So you're going to have you're going to get an example, but I'll describe this now. It's going to be almost like you look at, it's going to have maybe 4 columns. And you're going to have like a section. And the section will be like business lending. The next section could be consumer lending. Then it could be HR, because we look at HR. Then you also could have loan administration, you know, kind of the back office. And it will have finance department. So it'll actually also include like development of financial statements, you know, payments, etc. And you could also have a section for other risks, external risks, right? There's also external risk or political risk, which is part of external. And then the column will be the level of risk, right? The quantity of risk. The next column would be the quality of risk matrix, quality of risk management, sorry. And then the next column will be direction of risk, increasing, decreasing, the same. And then the final one will be comments. But you're going to get a copy, and I apologize. That's a great question. I should have shown an example, but it looks actually very similar to this. And this is one section. This is loan administration. And what you're going to get is the example. I hope you answered your question. And then you have a Marte. We have another question. Go ahead.
Marte, your hand is up.
Yes, my hand is up. I just wanted to ask, in crafting your risk appetite statement, do you do that for each area of risk? So let's say credit risk, operational risk, technology risk. Do you craft a risk appetite statement for all these types of risk?
That's a good question. So normally you don't, but you will have. So if we go back, that's a very good question also. If you go back here, let me go back here. Oh, sorry. If we go back here, oh, sorry. I want to, there. So you have the risk appetite, right? And then it's going to have sections probably that touch upon each risk, right? So let's say the portfolio risk or delinquent loans, no more than 1%, no charge-offs, right? That will be one of the target risk limits. But then underneath it, on the base, you know you're going to be monitoring a lot more of the risk, and it'll be a risk appetite set. There'll be even fuller credit risk targets that you're going to be looking at. So usually on a risk appetite, you'll have one that touches on risk, credit risk, or 2 or 3. And underneath it, though, the risk department should have a bunch of other criteria that they're monitoring. For example, you know, portfolio growth. If all of a sudden you see your portfolio growth 50% in 1 month, well, you know, risk is worried, because how the heck did your portfolio grow in 1 month 50%? It's kind of scary, right? You know, you got to go check what type of loans are going out the door, and are they underwriting them, or are they just throwing money out the window? So I don't think there is a risk appetite for each risk, but you will have a risk profile kind of benchmarks that you're going to be monitoring, and then that dashboard. It's a very good question, because you can put it in a dashboard that you could then give to your management team of credit risk. You have a question, Alex?
Thank you.
Yeah, there's a question in the chat box. It is saying that I did not hear you say anything about compliance risk, which is considered an integral part of risk management. Where do you place the role of compliance under risk management?
Okay, so let me get here. Right here is compliance risk. And the risk appetite will be 0 tolerance. What it's saying, no fines and no headlines, no breach of directive. This no fines is saying you could also say fully comply with all, you know, of the National Bank of Ghana's regulations, right? Like this is where 0 tolerance for non-compliance comes in, exactly there, okay? And in the risk matrix, very good point. I don't know who answered this question, but they know risk. You would also have a section in your risk matrix about compliance. Compliance to regulator. So you can have a couple forms of compliance, right? You could have the regulators compliance, you can have compliance to investors. So I've seen it where, like, if you have a big investor, they have some reporting and some benchmarks you have to adhere to. So it is, you would have, adherence in the matrix to this compliance of your investors and to your regulators, and that the compliance reports you would also have in the risk matrix that are being completed in a timely manner. Very good. Yes, no, compliance is absolutely one of the most important. Any other questions? One other question I get often is, why can't management develop the risk appetite and the board just approves it? So this comes out of actually, the reason why the board has to be the one developing this is the crisis of 2010, when many financial institutions, banks and non-banks, failed. They found that the board of directors did not understand the risk that was being accepted by management. There was more risk in the financial institution than the board understood. And what they found is because management was dictating the risk appetite, the board wasn't. At the end of the day, a board is supposed to be overseeing and governing the institution fully. So that is why it's recommended, management can work with the board, but really it's the board that should be setting the risk
One
appetite.
thing I like about it is that they stick to time. They
Excuse
say
me?
1 to 2.
Oh, sorry, that's someone else was gonna. So anyway, that's why the risk appetite needs to be developed by the board. And so here's another question I've got. Oh, there's another question. Okay, is there another question?
Donna, there is a question in the chat box.
Mhm.
How do you score risk levels in the different components of the risk matrix?
How do we score them?
How do you score risk levels in the different components of the risk matrix?
The risk levels. I'm not sure if I understand the risk levels, but if we look at this is how we're scoring risk, or how we're looking at it. It's like I said, you look at, one is the quality of risk management and the quantity of risk. And like I said, the quantity of risk is always going to be normally the dollar impact on the financial institution. And then the quality of risk management is the oversight and understanding. So if you have something that is a high quantity of risk, meaning it could have, if it does not go well, like you make a lot of bad loans, right? Because your policy is wrong and people aren't, let's say your loan officers aren't trained. And they don't know what they're doing, right? They're not good loan officers. They're making bad loans. The quantity of risk is very high. And your quality of risk management is weak because you have not trained maybe loan officers, and like the policies are not updated. So that would mean it's a high risk for the institution. Hopefully I answered that question for you. Is there any other questions? Alex, do you see?
No, there are no other questions yet.
Okay, one other question that I'm going to answer. Is it Marty, do you have one?
Yeah, sorry, but aggregate risk. How do you measure aggregate risk?
Okay, so that would be the aggregate risk profile that I'm showing here is like that high is the quantity of risk is high. Your loan officers are not trained and the policies are bad. The quality of risk management is weak. Your policies are bad and you haven't trained people. So that would come out, if you look across, high and weak is a high. If you remember, I said about the petty cash that a branch may have, tiny amount of cash they have to, for things that the branch needs to pay for. The quantity of risk would be low if we look at this matrix. But because if we were to lose all that money, the petty cash, it's not impacting the financial institution, so that's low. But maybe the quality of risk management, I talked about at this one institution, there's no really good documentation when people were using the petty cash, is weak. But if we go weak and low, it's a moderate risk. I hope I answered your question.
Okay, thank you.
Okay. Any other questions?
Yeah, the question here, should an institution include personnel management in risk policy documents? Should an institution include personnel management in risk policy documents?
So in a risk matrix, yes, we would include HR, because HR is a risk, right? If you're not hiring, okay, here's an HR risk for you that I've seen, that people, like we had many positions, empty positions in an institution, and unfortunately they weren't being filled quickly, or they were being filled with people that weren't qualified. That was an HR risk. The other thing is, another HR risk is if you don't have your HR policy clear, maybe for a staff. Unhappy employees that don't understand their benefits and don't have a clear understanding also are a risk. They'll leave the institution, and then we have to hire people, and then we have to train people. Whenever you have a high turnover, and that's one thing, when you have a high turnover of staff, that's a risk, because then you got to retrain people and it takes money. Is there another question? Alex, is there another question? I can't see.
No, there are no other questions yet.
Okay, does anyone have their hand up, or is it?
Okay, let me lower it then. Okay, there's a question here. There's a question here. With the risk matrix, can we also use figures 1, 2, 3, 4, 5, and rather give parameters to the figures low, moderate, high?
So okay. Interesting question. I mean, yes, you absolutely could. I think the reason many institutions work with this kind of, we call heat map, right, with the colors, is it's easier, and some of the risks, right, could be, it's hard to put sometimes the risk as a 1, 2, 3, 4, 5. I mean, you could actually somewhat put this, the greens and the yellows and the reds, into numbers if you wanted to. But yes, you can do that. But I think for this type of matrix, what it's used for at the management level, it's not best to put hard numbers. It needs to be a little bit flexible and a little bit less rigid with looking at the risks. I know internal audit will put numbers on, and that's absolutely fine when they're looking at risks. Internal audit will do that because they have a more of a rigid process they look at this. This is more going to be management thinking about holistically, and risk coming and saying, this is why we think it's a moderate risk, and let us explain it to you. But yeah, you can change it to 1, 2, 3, 4, 5 if you wanted to. And any other questions, Alex?
No other questions yet.
Did Marty raise his hand again?
No, it's an old hand.
Oh, okay. It's an old hand.
Yes.
Well, I think that's it then. I mean, if there are additional questions, of course, you can forward them, because there is an email here on the present. Oh, yeah, here we go. Sorry. There's an email here, and you're going to get a form to fill out. If there's any questions, feel free, you can send them to this email here, Binyams, and we can answer it. I can definitely give the answers and they could forward it back to you. I think when you see the tools, it'll be clear. But again, if you have any questions, feel free and we'll get back to you. We appreciate your time, and hopefully this was interesting. And I hope my goal is just that you got a couple things out of it. And again, you'll get everything, including this presentation, within the next 24 hours. So I really appreciate it, and thank you again.
Thank you too.
Thank you.
Thank you. You are welcome.
Mr. Jemfi, are you there? Mr. Jemfi. Let's hold on and take from Mr. Jemfi, please.
Hello, colleagues.
Okay, sir.
Oh, yeah.
Yes, sir.
Yes.
Thank you, Mommy. Thank you. God bless you for your presentation.
Thank you very much for making time for this afternoon's presentation. For those of you on it, please let your colleagues know that there's something good that is happening and they should not be left out. This is only the first one, and as you might have been told, we'll do another one in December that will cover what you call developing a digital strategy. And then in January, we want to look at how to prepare our institutions to be investment ready. So that one, I want everyone to make time for it. The other bit is that all the other trainings that will also be done in person, we'll later on inform you. And then those of you who will join can also have other information and other knowledge from, especially our international expert that we are bringing on board. In fact, you've done risk over the years, but what you've received today is entirely different from the things that you know. And I believe that you make use of them as and when they become needed in your institutions. So on this note, I will say thank you to everybody for making time for it. And we look forward to see you in another webinars. Yeah, Alex.
Yes. For the purpose of the materials, we want everybody to type in his or her name, the institution, the email address, so that we can forward the materials to them. So please, if you have not done it, quickly do it now so that we can send materials to you. If you don't have your email in the box, please type it in the box. Thank you so much.
Thank you, Alex, for the reminder. And so we are expecting everybody to receive the materials, and then as and when some needs also come, you can always contact Gamfen and the team for any support. Thank you very much, and I wish you well.
And thank you too. Happy birthday.